particular question, this one here, are you able to just leave down there the reverse variances you know of? The reverse variances? Do you know any of the reverse variances? So I'm told the sales volume variance, if the company is using absorption costing, is one of the reverse variances. Okay. Fixed overhead volume variance is reverse variance number 2. Then all sales variances. So we start with the sales volume variance or sales margin or sales margin, volume variance. Then we also have selling price variance. Another variance, they're supposed to be 4. Fixed overhead capacity variance. And of course, that is the only variance that is making what we call the fixed overhead volume variance to be a reverse variance. Perfect. So having said that, can we now see what was given in the question? The question says that the following information relates to the actual output cost and variances for the month of May 2022 of a single product branded tea manufactured by KK Limited. Actual production is given as 36,000 units. The actual costs incurred are direct material, direct labor, variable production overheads. Variances are also given down there, all the way to the last part. Then additional information number 1, we are being told that there was no opening and closing work in progress during the period. Number 2, variable production overheads varies with labor hours worked. That is variable production overheads. Then we're also being told here that the company operates the standard marginal costing system. That's interesting. What are we required to do? We are required to come up with what we call the standard cost card of product T for the month of May 2022. Always said that questions of this nature, we are supposed to know the standard, right? We are supposed to have standard cost somewhere here. We're supposed to have actual results somewhere here. Then these two will enable you to do what we call variance analysis, right? Variance analysis or variances. Now, out of these three, can't hear you well. Are we okay with the sound? Can the class confirm? Do you have a problem with the sound, or is it okay? Confirm, is the sound okay? No, it is fine on my end. It is breaking. Okay. What do we do? Loud and clear. Okay, on my end. Yeah, I think it's okay. Not really, but we can proceed. Let me see what we can do. But now, is it okay, or we have now echo? If you operate that way, will it be okay? Okay, thank you. So we can proceed that way. We can proceed that way. Good. So the first thing you're supposed to look at the variances that are given, in other words, the standard cost cut. So here, we don't have this. This is what has been eliminated. We have actual results. Somewhere, we have variances. Somewhere, what we are lacking in our question is basically the standard cost cut. That is what we are supposed to use to be able to deal with this particular question. So how do we fill in this blank space? This is the blank space we're supposed to fill by using what we have been given by the example. So first forward, let's look at the variance that are given in the question. The first variance I can see, I think I don't need this. The first variance I can see in our question is direct material price variance. Direct material price variance. So you'll come here and tell us, okay, direct material price variance. Direct material, so material price variance is equal to the standard price of that raw material minus actual price of that raw material. This should be multiplied by actual quantity purchased. Actual quantity purchased. Good. Now, can we look at the price variance that has been given? Remember, this is not a reverse variance, so you get a negative, you call it a negative. I can see that the amount is 30,000 or 300,000 favorable. A positive of 300,000, right, is equal to the standard price, which we are looking for, minus actual price of raw material. Do we have the actual price of raw material? Do we have the actual price of raw material? And remember, it is price per unit. What is the unit of measure of our raw material? It is given there in kgs. So when I talk about standard price or actual price, it is actual price per kg of raw material. It is standard price per kg of raw material. So please go ahead and give me the actual price per kg of this raw material. 28. Again, don't forget, the rule in variances or standard costing is that you should not round off, right? You should not round off. So how do we get that? I can say you have been given 8 million, right? 400,000 as the cost of this raw material, which is equivalent to how many kgs? 300,000 kgs. Not really, but yes, 300,000 kgs. So having gotten that, I'll come here, and our formula says multiply by actual quantity purchased, which is 300,000 kgs. Good. Can we now break the brackets? I'm told if you divide this, it gives you our own number, which is 28. So come here, compare what is inside the bracket. 300,000 is equal to standard price, which of course when you multiply by 300,000 will give you 300,000, so 300,000 SP, right? Minus this divided by this is the same amount, gives us 8,400,000, right? 8,400,000. Good. So having done that, can you collect the right terms? This will cause the equal sign to be a plus. So we'll get a plus 800 or 8,400,000 plus 10,000. That will be equal to, so 300 standard price is equal to this will be a plus to be 8,700,000. Can we now divide the 300 here? Divide by 300,000 here. What is the standard purchasing price of a kg of raw material? The standard purchasing price of a kg of raw material. $29 shillings, right? So we go to shillings. 29. Good. Having done that, you're supposed to proceed and look at material usage variance. So material usage variance is equal to the standard quantity of raw material in actual production, right? Minus actual quantity of raw material, standard quantity of raw material in actual production, minus actual quantity of raw material, then multiply by standard purchasing price per kg of raw material. Good. So having done that, I'll come back here. Good. So I'll come here and talk about standard quantity of raw material in actual production. What are we producing? We are producing the finished product. So please get to understand that in this topic, the company does production. And for them to do production, they get raw material. So whatever is being purchased, whatever is being paid for is raw material, not finished product. right? Again, what is being produced is the finished product. When we talk about actual production, look at the quantity of the actual product, right? Why are we talking about standard quantity in actual production? Yet, we just need to get the standard quantity. Why can't we check standard quantity in budgeted production? The issue here is you budgeted to produce 1,000 units, right? Then it happens that the actual units you have produced is 5,000 units. You cannot compare actual, right? You cannot compare actual cost of 80,000 with budgeted cost, right? With budgeted cost of 20,000. It cannot make sense at all, right? If you did a budget to produce 1,000 units and your budgeted cost was 20,000 units, your actual production is 5,000 units with an actual cost of 80,000. We can't compare this and say the variance between these two is 60%. No, that cannot work. Why? We cannot do comparison when we have difference in quantity. We must equate the unit. So we come here and tell us if my budget was to produce 1,000 units and I was to utilize 20,000 shillings. Now here, my actual production is 5,000 units. The question is, if my budget was to be for 5,000 units, how much would have been my budgeted cost? So talk about 5,000 times 20,000 divide by 1,000. Divide by 1,000. So when you cancel this, it gives you about 100,000, right? 100,000. So once you equate the units, if I were to use budgeted cost or budgeted production of 5,000 units, I would have talked about budgeted amount of 100,000. Then I now compare with the 5,000 units that have actually been produced, which the company incurred 80,000. Your budget was 100,000. You've actually incurred 80,000. You have saved. So we have some savings, right? We have some savings compared to the wrong procedure where the company was to say, I budgeted to use 20,000, I've used 80,000. So I have 60,000 advance. No, there's nothing like that. Does it make sense to somebody now? Does it make sense to somebody? Yes. So it is because of this effect. In other words, instead of following all this long procedure, we summarize it by coming to this part and saying it is the standard quantity, right? It is the standard quantity in actual production, right? How many units are we actually produced? We multiply by the standard budgeted cost, which gives us budgeted cost of 100,000. That is what we are summarizing in this part of the bracket. Standard quantity in actual production. So do we have standard quantity of raw material that was to be used? No. That is what we are looking for. What about actual units produced? Do we have that? Actual units of the finished product? If yes, how many units are there? How many units? 36,000 units that were actually produced of the finished product, right? Good. Again, to clarify, sometimes it is not that production, right? Production is equal to sales. It is not an obvious thing, right? In the event the examiner tells you that quantity that was produced was fully sold, you can now take that as production being equal to sales. But if I want to make you at least learn a little bit and be able to give you a different quantity of what was sold from what was produced. So in such a case, you have to be very keen. When talk about actual quantity, it is not actual quantity sold, it is actual quantity produced. So please take note of that. Good. Let's proceed. Do we have the material usage variance? Material usage variance in our question. I can see it here as 180,000 adverse. Remember, this is not a reverse variance. You get a negative, you call it negative. So a negative of 180,000, is equal to standard quantity, which we are looking for. All right, standard quantity in actual production, which is 36,000, right? That we minus actual quantity of raw material used in the production. How many units of raw material they use in the production? Again, it is not something that it is not always obvious that what was purchased was fully used in production. We need to look at what was actually used in the production process. So how many units were actually produced? If the examiner is silent about what was used in production and they have only given you what was purchased, you work under the assumption that what was purchased was fully used in the production. Perfect. So let's come here. Actual quantity 300,000 kgs. Okay. This should be multiplied by the standard price, which happens to be 29 shillings. So let's break the bracket. When you want to break the bracket, I talk about a negative of 180,000 is equal to, so standard quantity, a known figure, times 36,000 times 29. In simple terms, just take 36,000 by 29. 36,000 by 29, what are you getting? 36,000 by 29. 1044,000. So we have 10. Standard quantity minus 300,000 times 29. I think it's taking us back to 8,700,000. Somebody to confirm? Is it true that 300,000 by 29 is giving us 8,700,000? Yes. Good. So let's collect the like terms. This is a negative, right? A negative of 8,700,000 will cause the equal sign to be a positive, right? It will cause the equal sign to be a positive. So negative 180,000 now plus 8,700,000 will be equal to 1044, right? 1,000, so now SQ, standard quantity. So can we get the net amount here? And then we divide by 1044,000. All of this divided by 1044,000. So what is our standard quantity? What is our standard quantity? Standard quantity. Standard quantity 8.160. 8.160. And that is standard quantity of raw material, which of course is given in kgs. For us to produce 1 unit of product T, we need 8.169609 kgs of this raw material. And the cost per unit of raw material is equal to 29 shillings. That is it. Are we together up to that point? Are we together up to that point? Are we together up to that point? Thank you. Let's go to labor. Under labor, we have direct labor rate, we have direct labor efficiency variance. So let's go to labor rate. Labor rate variance is equal to standard rate minus actual labor rate, then of course multiplied by actual hours. Multiplied by actual hours. Perfect. Now, do we have the labor rate variance? Yes, it is 160,000 adverse. A negative of 160,000, a negative of 160,000 is equal to standard labor rate, which we are not given, minus actual rate. Do we have actual rate? Definitely no, but we have actual cost of 54.40 and actual labor hours of 64,000. All right, so we multiply by actual hours, we get 64,000. Let's break the bracket. So a negative of 160,000 is equal to 64,000 SR, 64,000 SR minus 5440 divided by 64,000 times the same 64,000 gives us 5440. Gives us 5440. These are negative. If it crosses the equal sign, it will be a positive. So 64,000 standard rate is equal to now a negative of 160,000 plus 5440, right? So divide both sides by 64,000. Divide both sides by 64,000. Good. What is the standard rate per hour? Standard labor rate per hour? 82.5. 82.5. So that is shillings. Everybody is given in shillings. Very important. The next thing is labor efficiency variance. Labor efficiency variance. Now, labor efficiency variance is equal to standard hours in actual production, standard hours in actual production minus actual hours. We multiply by the standard labor rate. Do we have the labor efficiency variance given to us? Yes. The labor efficiency variance is 320,000 favorable, right? A positive of 320,000 is equal to standard hours, which we do not have. What about actual production? Yes, we have 36,000 units. So it is S8 times 36,000 units. And remember, we compare with actual hours, which happened to be 64,000 hours, right? Then we multiply this by the standard rate, which is now 82.5. Which is now 82.5. Good. Let's come to this part. Let's break the bracket. So 320,000 is equal to SH by 36,000 by 82.5. What are you getting? In other words, just take 82.5 by 36,000. Take 82.5 by 36,000. What are you getting? What are you getting? What are you getting? 29,70,000. So you'll be having 29,70,000, right? 29,70,000 SH minus 64,000 by 82.5. What are you getting? 64,000 by 82.5. 64,000 by 82.5. 52,80,000, right? So that's 52,80,000. 52,80,000. Can we collect the line terms? Can we collect the line terms? Yes. So this will cause the equal sign to be a plus. Now, 29,70,000 standard hours is equal to positive of 52,80,000 now, plus 320,000, right? Plus 320,000. So we divide this side by 29,70,000. 29,70,000. We'll be able to get standard hours. Standard hours. Standard labor hours. Standard labor hours, 1.885. 1.885 hours. Perfect. That is it. For labor, we are done. For material, we are done. Now, I want to give you some things that you need to look at the moment to get to this point. Number one, look at our question. Is there any information or additional information telling us that the variable production overheads were being absorbed based on labor hours? Or in other words, the company used labor hours to absorb the production overheads. If yes, then labor hours being the cost driver, the standard labor hours that we have under the labor variances will be the same as the standard labor hours we need to be able to deal with the variable production overhead. In other words, look at any variance question. If the company is using maybe absorption costing or marginal costing, and the overheads are being absorbed based on labor hours, look at the standard cost card. In most cases, the standard cost card will give you the same budgeted labor or standard labor hours. The same standard labor hours for labor, same for variable overheads, and same for fixed overheads, if the company is using that. In other words, I'm trying to tell you, if that is what we have in our question, then I don't need to waste time calculating standard hours. It is already available. That same standard hours will be used to deal with the variable production overheads. But let's see if you have maybe a difference of 1 or plus or minus 1. We have information number 2. The variable production overheads varies with the labor hours worked. Perfect. The next variance is the labor or variable production overhead expenditure variance. So variable overhead expenditure variance is equal to standard rate minus actual rate, multiplied by actual, multiplied by actual. Good. Do we have the variable overhead expenditure variance? Yes, 120,000 and plus a negative. So a negative of 120,000 is equal to standard rate. Do we have standard rate? No, we are not having. Minus actual rate. Do we have actual rates? We can get that. So we go to the actual variable production overheads of 1520, right? 1520. We divide by actual hours of 64,000, right? Multiply by 64,000, right? So let's break the bracket. A negative of 120,000 is equal to 64,000 by SR, 64,000 SR, minus, this is 1520 divided by 64 times the same 64. It leaves us with 1520,000. Good. I wish we had one of the reverse balances. But of course, in our next meeting, we'll be able to look at that, where we have one of the reverse variances. So they are giving you that the figure is reverse. In other words, it is adverse. So what do we do? Should we proceed and put a negative? Let us see once we're done with this part. So we have a negative of 1520. When you're calling the right terms, these are minus. If it crosses the equal sign, it becomes a plus. So 64,000 standard rate is equal to a negative, this one to be a positive, so negative 120,000 plus now 1520,000, all right? $64,000. So is the standard rate per hour. Standard rates per hour 21.875. Good, that's great. Any other person? 21.875, 21.875. That seems to be correct. 21.875. That is what we have. Great. Now, will we still waste time trying to calculate standard hours? Definitely it is here, but let's try. So, standard, or that will be calculated using what we call variable overhead efficiency, but it is standard hours in actual production minus actual hours times the standard rate. So let's go ahead. Let's go ahead and try that. The variable overhead efficiency variance given to us in the question, I can see is 80,000 favorable. A positive of 80, a positive of 80,000. So I'll come here and bring the positive of 80,000. Right? I'll compare with standard hours, which I do not have, under the assumption that we don't have it. So standard hours, we multiply by actual production of 64,000. We less actual hours, sorry, not 64, but 46. Sorry for that. Actual production is 36,000 units minus actual hours of 64,000. Then standard rate is equal to 875. Standard rate is 21.875. Having done that, let's now break the bracket. We have 80,000 is equal to, can you take 36,000 times 21.875? 36,000 times 21.875. Now, it will give us 78,750. 78,750 standard hours minus, when you take 64,000 times 21.875, what are you getting? 21.875 times 64,000. 7,877,500. What are you getting? 1,400,000. So 64,000 times this is giving us 1,400,000. 1,400,000. Good. Once we have that, can we collect the like terms? This one here is a negative. If it crosses the equal sign, it becomes a positive. So let's have 7,875,500 standard hours is equal to a positive of 14, 1,400,000 plus 80,000. So we divide both sides by 7 with the 7,500, divide by 7,875,500. What is our standard hours? What's our standard hours? Standard hours. 1.8794. 1.8794 hours. Good. So let's see. If I have these two decimal places, that is 1.8. 1.87, these are 1.8. So you can see there's a slight difference, but supposed to be the same. So I'm having that slight difference is because of some decimal places we had somewhere. There's some decimal places we had somewhere. Where is it? Some decimal place, some rounding off was done somewhere here, right? We did some rounding off, but ideally we expect this one to be the same. So, for example, if you round off to, we are to round off this to the nearest whole number, you are to have 2.0, that's the same. If you round off to one decimal place, this will be 1.9, this will be 1.9. Yeah, something of that kind. So this one here, we give you. But of course, sometimes we try so much to make sure that you don't have these decimal places. I'm able to give you another question where this one is exact, but this is allowed. Another way, if remember what I said, already we have been told in information number 2 that the variable overheads are being absorbed based on labor. So the standard labor hours that is here is what I'm supposed to copy to bring to this other side. Actually, I'm not supposed to even struggle with calculating the standard hours. Just come and say standard hours is equal to this exact amount. So that will be allowed. That will be permitted. Is that okay? Are we okay up to that point? Are we okay up to that point? Good. Remember, we have not answered the question. What are we required to do? Please read it again on your own. Somebody might assume we have answered the question. No, we have not answered the question. Please read what is required. Required standard cost card. What we have here are components of standard cost card. So how do we come up with a standard cost card of a unit of product T? I'm requesting you to give me these figures. For example, this one here, 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 and also this one. So please don't let me down. Give me those figures. Give me those figures as I know finalize for the standard cost card. Those figures. So I'll come here and say standard cost card. Standard cost for by unit of product T. Right? So the first thing is direct material. Direct material. There is about how many units? 8.1609 kgs that are required at shillings 29 per kg. Direct labor, right? Direct labor standard hours is 1.855. So for uniformity, we're supposed to have a common thing, but no problem since I've explained why we have that difference. Let me do this so that you can understand that. Allow me to use this and say 1.8 or 1.9. We can use 1.9. Allow me to use that just for some understanding. 1.9. Note standard hours should be the same. Standard hours should be the same. Yes. Standard hours should be the same. So we are going to use the rounded off figure that is 1.9 hours. 1.9 hours are needed at shillings. The standard rate is 82.5. That is for labor. Standard 8.5 per hour. Then variable overhead, production overhead. Variable production overheads. Right, variable production overheads. We have 1.9 hours. Right, hours. At shillings, what is the standard rate? 21.875. 21.875 per labor hour. That is what we have. So let's come here. I think the ones are not gone. I don't need to return them. So let's start with the base part, yeah? When you multiply 8.1609 times 29, what are you getting? Maybe round off down to two decimal places. 8.1609 times 29. What are you getting? 236.67. 0.67. 236.67. I can see two different answers. Let the third person give us the answer for us to confirm who is right between the two. The third person, it is 0.67. Thank you. Good. Number 2. When you take 1.9 times 82.5, what are you getting? 1.9 times 82.5. 156.7. Then we go to number last, 1.9 times 21.875. 1.9 times 21.875. That will give us 41. That will give us 41.56. 41.56. Good. So we have direct material, we have direct labor, we have variable production. Can we add the three? Can we add the three? Can we add the three? 434.98. 434.98. Now, remember, we are actually done with the entire syllabus. If you are studying at RCM, I believe you are done with all the topics. So, I want somebody who will be learning from May to date. What is the right name we are supposed to have here? Look at our standard cost card, study it very well, compare it with what actually you were taught from the previous topic. I'll give you an hint. The last part of topic number 4, topic number 7, and now topic number 10. What is the right name I should be able to put here? Thank you, Damaris. Marginal cost, right? That is the marginal production cost or variable production cost. Variable stroke marginal production cost. That is it. That is what you are required to look at how simple that is. Contribution margin is only mentioned when you have sales. So are we given selling price per unit? Are we having standard selling price? No. So contribution margin will not come here. But it is marginal cost. When you take the marginal cost, you will get the contribution margin. Is that okay? Any other problem? Or should we disappear? Any other problem? The next thing you'll be told to do is being interview. What happens is you just need to have a clue on the reason why you're supposed to understand all the topics, because the moment you get a question, you know, I can give you a question that covers topic number 8. This question covers topic number 9. This question covers topic number. Like I can use one question to bring so many things. Like what we have here, I could have just given you what we call the fixed cost, right? Actual fixed cost or standard fixed cost. Then I'll give you standard selling price. The next thing I'll be doing is to tell you to give me break-even point in units. Or after getting this variable cost, I'll give you total fixed cost and tell you to give me cost function in the form of y is equal to a plus b. Look at what we are doing. Topic number 10. Look at what I'm asking you to do. Topic number 3, right? Cost function. Then I'll be telling you or giving you a question where we have what we call the concept of topic number 5. I give you a question that requires you to do all that, only to tell you to give me what we call cost function using what we call account analysis method. In account analysis method, what happens? We're supposed to get total variable cost, total fixed cost, but for the total variable cost, we use the cost driver. Those who attended the mock, you must have interacted with something of that kind, especially mock number 2. Mock number 2, there's a question that was cutting across. The question was presented like topic number 9 question, right? Budgetary control. But when you went to read information number 1, it is taking you to do a concept in topic number 3. Then proceeding, it is telling you to do something in topic number 8, what we call break-even point analysis. So that was a nice question. What you need to do is to understand. The moment you read a question, what are the possible topics where this question could be coming from? Then from there, the moment we have topic number 7, we just know marginal absorption costing. What are the components of marginal cost? What are the components of absorption cost? Then you proceed. Because I can see also topic number, there's a question, I can't recall the exact dating. It is in December, either 2024 or 2023, right? A question is given, you're supposed to use ILO method to get variable cost per unit to get total fixed cost. Then from there, you're supposed to use marginal costing system to come up with the income statement, use absorption costing system to come up with an income statement. Then you finalize with a reconciliation statement. Yeah, so that is how it operates. That is it. Any challenge before we disappear? Anything or a short question that is challenging you, which you have been waiting for a single day to actually clarify? A simple question or a brief one that is challenging you. A brief question that has been challenging you. Yeah, there is. So I think that's enough for today. For those who have not joined RCM, please get to understand this. Number 1, we are currently doing some great mocks. Yeah, during the mock, we are going to do one. We have one in the mocks, which we are going to revise. So those who have joined this free class and you have not registered for your class at RCM, please do so. Now, somebody will be wondering, how can you tell me to register now, yet you have already said you are done with the syllabus and I'm not going to gain anything much? Please, this is the strategy. I'm thinking of how we are going to revise the mock papers. The 2 sessions per week will not be enough, but I want us to strike a deal tomorrow during our normal class. That deal will allow us to revise even on the days when you don't have a class, like not given in the timetable, specifically for that mock revision. Those who will not manage will be able to access the video. The solution will also be available, right, in PDF form for your review. So those who have not attempted the mock, please attempt that mock. Those who are not, or those who have not registered at RCM, make sure you register specifically for that mock, because that mock cuts across, and I want to revise that entire mock. The moment I'm done with that mock, I'll tell you, if you understood everything in the mock, please wait for your exams. If it's on Tuesday or Wednesday, you wait for that Wednesday or Tuesday. You'll be good to go. And during that mock, I'll be preparing you to be the best student in this sitting. Not 50, no, 50% you are past that. I'll be preparing you to be the best student in that sitting. That is my aim. 1K is enough. So what I do for the other units, of course, currently the college is charging around 2,500. Let me take it this way. Please, for the management accounting student, these are offer you are having. So you'll be charged 1,500 for us to be able to revise that mock. So this is the pay below, right? 62, 42, 839. Account number, please just indicate account number, just indicate 33809 MA. 33809 MA. By doing that, you'll be able to understand your interest. Just pay that amount, right? Amount. For only management accounting, other units, the rate remains the same, 1,500. They have 3 mocks. 2 mocks, you are to do them under exam environment. That is exactly 3 hours, and then you submit your workings. The 3rd mock is an open mock. You can even discuss or just do it without the pressure of 3 hours, right? This one is for an RCM or RCM students. If you did not register for any class at management accounting for this semester at RCM, we will charge this amount. Those who paid RCM for the normal classes, don't be tempted to pay even a single cent for this mock. No. Don't be tempted to pay even a single cent for this mock. You'll access this for free. That is RCM for you. No additional charges. For your case, you get the mock for free. You do it for free. We discuss it for free. But if you do not register for management accounting unit at RCM for this semester, RCM will be telling you to pay 1,500. We revise that mock paper and even get the solution for the 2 mocks. The solutions are ready, right? Just to strike a deal, and then we close on this unit for this semester. Yeah, that is it. If you are not given the outpost price, can we assume that? No, you don't assume there's an outpost price. Then it means the goods that they could not produce were ignored. Now, that is answered in the concept. I think I've answered that. Thank you. What else? Yes. And just give the time. Don't allow us to Yeah, so I think that's enough for today. So I can leave you for now. So you run very fast, look at the 2 mocks, mock number 1, mock number 2. Those who have not attempted the mocks, I'll be able to share them in the group, right? I'll be able to share those mock papers in the group immediately after this class. You look at them, see what is there, right? Then we meet tomorrow to strike a deal on how to revise, especially mock number 1 and mock number 2 if time will allow us. But I can promise you mock number 1 will do the all of it. Yeah, that is it. So thanks for your time. Have a blessed afternoon, and let's meet tomorrow at exactly 6 p.m. for that great meeting.